right. Fubo TV stock became a lot more interesting to me after the deal with Disney and the merger with Hulu Plus Live TV. Before that merger in January of 2025, I had Fubo TV stock rated as a sell. I had it rated as a sell because the company's prospects longer term were so poor. The company was losing money on every subscriber. And on top of that, there was no reason for companies that owned content to give Fubo any kind of favorable treatment. But after the deal with Hulu TV, with Disney, that all changed. Now, initially, the stock price soared following the announcement of the merger. The stock price jumped over $5 a share, and at those valuations, I wasn't interested in Fubo stock. But now the price is down closer to $3 a share after falling more than 40% since the initial surge. So I wanted to revisit Fubo TV, reevaluate the company and its prospects, and update my rating on Fubo TV stock.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the first thing I'm going to look at is the company's revenue growth history, which has been decelerating noticeably in recent years, up only 8% in the most recent quarter. And I expected this to happen for Fubo TV. This was one of the reasons I had grown so pessimistic on the stock, is because it was losing so much money on the bottom line. It was losing money on every subscriber. So the only strategy forward I suggested for management was to raise prices, which was going to slow down growth because at higher prices, consumers have better choices on their live TV streaming options. Fubo TV did indeed raise prices and they started to slow down in terms of revenue growth and customer acquisition. But this deal with Hulu Live TV changes everything, right? So just to rehash the details of the deal, Fubo will be merging with Hulu Plus Live TV, and the combined entity will be 70% owned by Disney. So Disney's going to own 70% of this merged company, which will continue to be referred to as Fubo TV. They also will get a settlement from the partners that were going to launch the venue sports service. They're now going to get $220 million from those partners. Also, Disney's going to commit another $145 million as a loan to Fubo TV in 2026. So the deal changed everything for Fubo TV. It went from a company that I thought may not survive in the long term to a company that could very well be one of the leaders in this space, because Hulu Plus Live TV already had close to 5 million paying subscribers, and it was already profitable when Disney owned that segment, and now it's going to be shifted over to Fubo TV. Another thing it does is now there is a reason for Disney to give Fubo TV favorable treatment. Before this announcement, there was no reason for Disney, let's say, to give Fubo TV good pricing on ESPN, ESPN2, ESPN, etc., right? But now that Disney owns 70% of the company, Disney is incentivized to give them favorable treatment. It can negotiate better terms, it can extend payments, it can lower prices, give them favorable content. All of that makes Fubo a viable business now longer term. Whereas before, every subscriber was losing money, and there was no reason for that to ever change for Fubo TV, because Disney had its own live TV service in Hulu Plus Live TV. So it had actually no incentive to give Fubo TV any kind of deal when it was selling it access to ESPN and other channels to offer for live TV streaming. So before even the merger, Fubo TV, those price increases were helping the company reduce the losses in cash flow from operations. The company accepted the reality they could no longer continue offering lower prices just to attract subscribers while losing money on every subscriber. So they raised prices, and that was helping reduce the losses on the bottom line. And in the most recent trailing 12-month period, that came in at negative 4.9%. I wouldn't be surprised if over the next 12-month period, if this becomes positive and they're cash flow positive now, because they combined with Hulu Plus Live TV, which is already almost cash flow positive. Disney wasn't breaking out those numbers specifically, but Disney did say that the Hulu segment overall was profitable. And it's safe to assume that over the next 12 months, it can hit that inflection point and turn profitable, because it's going to operate at an even larger scale now. Instead of operating at 4.5 million subscribers, it's going to operate with over 6.2 million subscribers, and it's going to be able to get favorable deals from Disney on some of the most popular channels, on some of the most expensive channels that Disney has to offer. FuboTV can get those channels at favorable prices, thereby ensuring that the business is now on sustainable footing from here on forward. No longer will you need to be concerned that FuboTV may not make it in the long run. You can now be almost over 95% sure that FuboTV will survive for the next decade and more. And so those improvements in cash flow were also improving the return on investor capital, which is still significantly negative at 28%. But again, for the same reason that the cash flow from operations is likely to improve, the returns on investor capital are also likely to improve going forward. An additional benefit, which will not be reflected in the return on investor capital, well, it will be reflected in the return on investor capital in an indirect way, is that FuboTV's cost of capital will decrease. I mentioned on the previous slide that you can be pretty confident that FuboTV will survive in the long term. So that reduction of bankruptcy risk will reduce the company's cost of capital. And so partners will be more interested in dealing with FuboTV because they know it can be around for the long run. So whereas previously partners may not have been willing to sign a 5-year deal with FuboTV because they might think, I'm not so sure you're going to be around 5 years from now, so I don't know if I want to make a 5-year deal with you, or a 10-year deal, right? Which you see very frequently with these sports contracts and these content contracts. They're longer term deals, and FuboTV didn't have the ability to strike those deals, or the ability for FuboTV to strike those deals is now much stronger than it was before. So following that deal with Hulu Plus and Live TV, the free cash flows expectations changed dramatically for FuboTV. As I mentioned, I now expect the company to be free cash flow positive here in 2025 and increasing from here on out. I expect the company's free cash flow will rise to $550 million by 2029 and $710 million by 2034. And so when I updated my intrinsic value per share calculation today for FuboTV, I calculated a fair value of $11.18. Now, I'm not very confident in this calculation. My conviction on this price is not very high, given there are so many moving parts with this deal and this company surrounding the merger. So I'm giving myself a very large margin of safety here for FuboTV. But I can still be reasonably confident that my fair value per share for FuboTV is above the current market price of $3.18. And then when I look at FuboTV's forward price to earnings ratio at 37.35, it's a reasonable price for a company that now has a big improvement since January, since making this deal, and I just highlighted just a few of those benefits that FuboTV will now receive as now being part of the bigger company merged with Disney, and having a much larger scale now with over 6 million subscribers instead of just over 1 million subscribers. It's a whole new ball game now for FuboTV. And so to update my recommendation, I last updated investors on January 2nd, and I gave an update a few days after the announcement with Hulu TV when the stock price surged to over $5 a share. I upgraded the stock from a sell to a hold. And then today, I'm upgrading the stock again to a very cautious buy. And the reason I'm saying very cautious buy, because There's a lot of moving parts still to be known for this company. And this is a very rapid increase up the scale here. I think this is the quickest a company has moved up my scale from being rated as a sell to being rated as a buy. I don't recall any company moving up that scale as quickly for me in my several years of following companies and giving them ratings. I've seen a company move down the scale very quicker than this, and that was Chegg, the education technology company, and how quickly I moved that company down following the launch of ChatGPT and how it obliterated Chegg's business model. So I downgraded Chegg very quickly. But as far as an upgrade from a sell to a buy, I don't know if I've had one move up as quickly as FuboTV. So I'm going to put an asterisk around it and say that this is a cautious buy upgrade for FuboTV. I'll add more coverage for this company and investors looking at this. This is a high risk, high reward play here for long-term investors looking to capitalize on this newly formed company. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.